Welcome to Bill the Lender podcast, devoted to educating you on a variety of financial subjects with an emphasis on real estate and real estate finance. Please click the button to subscribe to my channel so you don't miss an episode. Then like and share your favorite episodes. Hi, everybody. Welcome to this week's edition to Bill the Lender podcast. I'm your host, Bill the Lender. And this week, doing a solo cast talking about challenges in the current market, because it is something that comes up a lot these days. And there's so much fear. There is so much fervor in the media about housing prices falling and appraisal amounts, falling 30% or 17% over a year-over-year basis. And it's just not entirely true. So today we're going to talk about some of the market dynamics as you're a consumer or you're an investor, really trying to navigate the market and decide whether now is a good time to buy that next investment property, buy your first home, or move up or move down, whatever it is. If you've had no prior experience to making those types of decisions in a market like this, it can be overwhelming. And it's hard to know where to get your information, because you would think that the media and the media experts would be out there to help educate you. And this is not always the case. Their primary job is to really sensationalize the news so that you will watch and they can pay their top dollar for the folks that want to advertise on their channels and not necessarily get down to the core root of the problem. So this is a channel that is dedicated to bringing real world knowledge and application from somebody who has boots on the ground and deals with this market on a day-to-day basis and educates consumers on making the right decisions. Because this is really what it's about, is having professionals that you trust to sit down with you and shoot you straight. This is financial planners, why we have financial planners, why we have estate planning attorneys. It's why we have good realtors from an investment perspective, or good realtors from a specific segment of the market, give their area of expertise and help educate you on how to approach a problem. In this particular case, it's going to be the markets and inflation. So in every market, there are unique challenges, and this is probably going to be a challenge segment of this podcast where we're just going to talk about market challenges despite whatever market we're in. In this case, we just happen to be dealing with high inflation, interest rates that are running away from us, and market appreciation that continues to run away despite what the media is saying, and why those market dynamics play into your decision-making process. So in this case, I had one of my partners ask me, how do you answer the question about the market? And so I want to take it from the rent versus buy perspective, and I want to take it from the investment perspective, because depending upon where you are in your level of expertise or experience, you're going to look at this market very differently on the spectrum of what you feel comfortable with and the challenges and how you see those challenges sort of play out in the market. If we are a first-time home buyer, or you're looking at making a move, or you've recently moved to this market, one of the things that's unique to this period of time in history is that interest rates have risen so much that, the cost to rent versus buy in that first year is actually more expensive. And this is something that the media talks about in the home affordability index. And there's a piece of that that's not true. That is true in the sense that you have down payment, you have closing costs, and then in some cases, depending upon what your needs are for housing, whether that's a one bedroom or a multi bedroom property, you may pay more for a mortgage than you would in some cases for rent. And I think it's important to note that everybody's situation is different. So when you're evaluating this on a spectrum of a consumer, what are the things that you need to consider? Well, first of all, what are your needs? If you are somebody that's in bootstrapping in your mom's basement or that 1-bedroom studio apartment to save money or correct their credit or wait for that great job, then right now it might make more sense to wait it out a little bit. Because you can save that money. You can make those corrections and you can do it at a relative cheaper cost than what it's going to cost for you to buy. And those are situations where that's just a real conversation, and everybody's conversation is different. But if you're somebody who's, established, housing is a need regardless of where you are in the income spectrum. It's a real need, just in life and your basic necessity, it's food and shelter. So whether you own that shelter or whether you don't is in some cases a personal preference based upon your individual situation. But if you're not at the bottom of the income scale, you're in the lower paying jobs, or you've settled in an area, because some people, there are reasons why they would rent. They've moved to Colorado. They're not necessarily sure that they want to be here or of their job situation. So they're trying to get the lay of the land, that it might make sense for you to rent for a period of time. But when you look at the numbers and the statistics for those who own versus those who don't, renting is not a long-term sustainable strategy, in my opinion. Okay. And here's why. Because first of all, rental prices continue to rise. And in a market like this where housing is short and tight, you're paying a premium to get into a rental. Maybe not as much as coming up with the down payment and closing costs, but if you're a first-time home buyer, there are, and maybe not for those who aren't a first-time home buyer but don't necessarily have the funds, there are programs available for you to use to reduce the amount that you need to come up with to jump into the game and get a foothold, because that's really what we're talking about, is getting a foothold and market dynamics that play out over time. When you're listening to the media, you're listening at a certain segment of time, and they're going to say this, it's great or it's not so great, depending upon what period of history you're in. But you need to look back historically and understand that in the last 5 years, 70% of Colorado's appreciation has hit in the last 5 years. So if you've been sitting on the fence for the last 5 years, you've missed a huge transfer of wealth. Massive. Okay. So now you're sitting again and going, oh, is now the right time? Is now the right time? Well, if anything, if looking backward shows you that there is not necessarily always the perfect time to jump in. In fact, timing the market is exceedingly tough because you never know when you're at the top or the bottom until that point is already passed. So there are certain segments that I think that you need to really adjust your mindset about. And that is, if we play to a certain amount of safety, that is to say, we're not going to qualify ourselves for more than that we can afford. Or maybe there are two wage earners in the household and we're only qualifying off of one wage earner's income for a best case scenario. And we play to these worst case scenarios. If those are, like I said, everybody's financial picture is different. But if you can take a conservative approach and you can weather the storm, what you're going to see is that the market always comes in cycles. The sky isn't always falling, guys. It just isn't. The sky isn't always falling, and it's not always rose-colored glasses. So there's going to be these ebbs and flows, right? And in fact, for our investor folks, and the podcasts that we partner with, Invest Denver and Invest Colorado Springs, you can't do a BRRRR strategy right now, buy, refinance, rinse, repeat, right? Because interest rates are too high. You finance, earlier on when interest rates were lower at 3%, 4%, 5%, the market's at 6.5%, 7%. That strategy doesn't make sense. But the point is that you own an asset when you choose to jump into the market at some point. And if you can weather that storm, no matter what the market's doing, whether it's going up or whether it's going down, you need to pick an exit strategy. You need to pick a hold time. Those are two critical points inside of this conversation. So, I'm going to buy a property. I'm deciding to jump in. I know that I'm going to stay there for a period of 5 years. Well, the market, big major market downfalls happen every 7 to 10 years. So a 5-year horizon is a really safe bet for you to put yourself smack dab in the middle of any market cycle. And as long as you're not pushing your income, you're not pushing your qualifying power, you can qualify by yourself, or a worst case scenario, you add a roommate, you rent by the room, you can subsidize that so you can weather the storm. As long as you can hold for that period of time, you're going to be safe, because things go up, things come down. Things go up, things come down. But what we've seen over the last 5 years is things have just continued to rise. And yeah, sure, they may come down a little bit maybe in this market cycle, but it's going to be at a much higher plateau. We're not going to lose 70%, guys. We're going to lose 4%, maybe, if we lose anything at all. So some specific markets will lose more, some will lose less, but we'll only be able to talk about average market dynamics on this show unless we start picking, neighborhoods apart by zip code. We're just not going to probably do that. The stats that we'll look at are national, and that's the way the news is brought to you guys. So everything that you're hearing as the best case or worst case is really a median. It's an average, and that's everything is going to apply specifically to your location and your situation. So know your time frame, right? Have an exit strategy. If I have to hold this for a period of time, maybe longer than I want to, can I turn it into a rental, take that cash flow and use that for a period of time before I want to sell it? Or can I separate my equity and buy another property? Can I, there's so many things that you can do, but you have to own the asset. If you don't own anything, you don't have anything to leverage. And that's why I say owning something is a better long-term strategy than renting. Because as you own this property, guys, you're paying down the principal in the asset. So you own more of it over time, which is more that you can leverage when the time is right, or you can qualify. Now, it still costs you something to tap a real estate asset. It costs you closing costs, and you finance at a particular rate, and you're going to pay, that money back. And if you pull any money out, you could be increasing that basis in terms of increasing your payment on that. But also, now that you own that asset, you get to take advantage of the fact that rents keep rising, right? And if you choose to hold on to that, separate your equity, and then roll it to the next property, or choose to sell that property, take that equity and use it to buy something else, that's the only time that happens, is when you own something. Otherwise, in comparison, you're throwing money away into this endless pit that never stops. And at the end of that cycle, 10, 5, 15 years, you still don't own anything. So that's why I say having something to hold on to is better in the long run. And the truth is, when you look at those numbers over time, the folks who actually own have a higher net worth over those that don't. So how do we deal with this current market? Well, we've got to put it in the proper perspective. Understand that things go in cycles. Things don't always go up. Things don't always come down. If we can plan for the worst case scenario. So if you're, a first-time home buyer, you're going to say, okay, I'm going to be in this property for 3 years. I can stay for 5 if I need to. This property will meet my needs. Or I bought a 2-bedroom condo. I met the love of my life. I'm going to keep this property as a rental for long-term investment, or I'm going to sell it. We're going to buy the next thing. But I'm going to keep it as a rental maybe and take that cash flow, and it'll pay for itself. And now I have the dual income, and now we can buy something else, and we can, have room for our family to grow, whatever that is. You can do that as long as you keep that awareness in the front of your mind. I don't have to panic and sell. I mean, I think that's sort of the thing that everybody thinks of when, oh my God, this market, does it really make sense? Am I going to lose my shorts? Well, no, because what goes up must come down, and what comes down goes up again. So as long as you can have that length of time where you can weather that storm, you're going to be okay. And then if you're an investor, it might be, what's my strategy here? Am I looking at making money? Do I need the cash flow to buy this property? And if I need the cash flow, right now it's really, really tough to cash flow. I mean, we've seen 70% appreciation, and then we've seen interest rates jump, 40% in just this year alone. So it's ridiculous to try to buy a property, need the cash flow. That's just really hard to do. If you can, not have cash flow and take the appreciation because you're going to hold that for 10 to 15 years because your horizon is long enough to see the market make you money, then that's what it is. And then, there's a perfect point that I'm going to come to here where the market is going to bring us an example of exactly what I'm talking about, because over that period of time, not only do rents continue to rise, as we've already stated, but the market is going to change, and you're probably going to be able to refinance and better your position on that property in terms of the cash flow, right? So if you can stomach the payment now, whether you're a first-time home buyer or a move up, move down buyer or whatever, and that payment is okay to you right now, knowing that there is at some point in the future where rates are going to fall and you're going to better your position, then you're in good shape, right? And that's a great example. Right now, our strategy, the value that we're bringing to our clients when they consult with our team is how to manage their payment. It's not how to buy a property, really. It's how to manage a payment. So I need to get a foothold in this market, or I just moved to this market and I need housing, or I want to continue to invest in real estate because I have seen what it has done over the last 10 years. It's always outperformed the stock market. I want to keep moving in this direction. How do I do that? Well, you got to manage your payment. And so you may be looking at ARMs. You may be looking at seller buy downs where a lot of times we're telling, advising both sides of the transaction, hey, you want to keep your premium. You don't want to drop the price when you're selling your home. Offer to buy your future buyers closing and buy down the rate and pay for their closing costs. Because when you buy down that rate, it has a bigger impact on the payment. The two biggest things that can impact your payment is the interest rate and the purchase price. But one impacts the payment more than the other. I've been running these numbers for realtors to show them the difference in a buy down versus a price reduction. And in some cases, the cost of the buy down is $12,000. To get the same payment, it's a $50,000 price reduction. In much larger payments or much larger purchases, it's way more drastic. I priced a $1.2 million property recently where the price reduction was $100,000, but the cost of the buy down was $24,000. I mean, it's a no-brainer because you're focusing on the things that are going to have the biggest impact to the payment, and that is what rate you finance at over time. If you can push that down, the better the affordability becomes. And you can now foresee yourself figuring out how to pay for that property because you're controlling the things that you didn't have control over, right? So buy downs are huge. ARMs are becoming more of a conversation. We're spending a lot of time educating the consumer populace on ARMs because after 2008, 2009, there was such a stigma put on exotic mortgages, and ARMs were thrown in there because people got in trouble. If you understand and are educated about the tools, the mortgage tools, because that's what they are, the terms, 30-year fix is a 30-year fixed mortgage. It has a structured repayment for a reason. It's a tool for you to buy something over time. An ARM has a fixed period that as long as you can manage the payment over that fixed period, that 3, 5, 7, 10-year period, you're going to be fine, right? And that stays fixed. And then when the opportunity arises, if you don't feel comfortable with that ARM and the market changes and the rate drops to where you are on the ARM, why wouldn't you refinance into a 30-year fixed mortgage and call it a day? Not a big deal. So really it is about helping people manage that payment, right? We might stick you in an ARM with the explicit instruction. In fact, I just had this conversation on Friday. I've got a consumer that is building a home for $669,000. When he started building the home, now we have builders, folks, that we manage. We would never do this, but they came to us because they didn't like the builder's lender. The builder's lender didn't have a conversation about our long-term locks and things that are really important in a market like this where rates are rising. You want to protect your cost to finance the home in the future when, rates aren't rising as high as they are now. And we were locking 60, 90, 150 days in my new builds to protect the investments that my clients were putting money on. And it saved them hundreds of dollars a month in their payment, and they're happy. But this gentleman didn't have that opportunity. He didn't sit down with us until the end and say, okay, you're my guy. We started at 4%. Now the rate's at 6.5%. And he's like, he doesn't qualify right now by himself. So either I have to add his wife or, he's got to make some hard choices, right? And she has her own situation where, all of that income is foreign income. We can probably figure it out, but we're also talking to him about all of his options on the table. We've got a great ARM product right now that is uber competitive, and that ARM gets him where he needs to go with the understanding that it's a 7-year fixed period. And sometime in the next 10 to 12 months, this is the opportunity that I'm talking about. The market is going to shift and he's going to be able to finance himself back into a 30-year mortgage because this is the property that he's going to stay in for the rest of his life. He's not going to leave this property. The only way he said he's going to leave this property is when they take him out on a gurney. So now I've got a short-term solution to help him qualify for the new build that he doesn't want to lose and the $10,000 of earnest money that he put up to do this new build, right? So there's a lot of money on the line. He qualifies short-term to meet the income and underwriting requirements. And then when the market shifts, then he can refinance into a 30-year. So it's helping folks understand what tools they have available to manage their payment and how they would do that and what the costs are, right? Because you're going to pay for financing twice. So now, from that standpoint, what are some of the other things that you need to be thinking about in planning worst case scenarios? I think if you're an investor, again, you want to shy away from looking at properties where your situation, you need the cash flow to qualify. This is not the time to be playing in that market. You need to be a well-heeled investor with enough cash reserves parked on the sidelines that if you're going to get into issue, you can get the property where it needs to be by putting more down, or you can weather the storm in the cash flow until the rents rise, or you're able to refi. Now, or you're looking at an ARM. And if you're looking at an ARM, you're still understanding the period of time that you need to manage to. Now, let's talk about these market cycles, because one of the things that the doom and gloom points out is just the immediate need to sensationalize the headline. And it doesn't really give you an accurate historical view of what the market does. And that is something that with my 17 going on 18 years of experience now, I've seen these market cycles, right? I've seen a few of them. I know what happens. I know what happens at the end, right? So, and that is valuable insight, because a lot of times when we're just listening We're consuming the fear, whether we want to be caught up into it or not. There's still this high level of anxiety for everyone right now because things are just, every time you go to the cash register, way more expensive than what you anticipated, right? So, when we see periods of inflation like this, the Fed does a cycle where they basically deny that inflation is an issue. They say it's transitory. And we've seen this, and I can break apart. I did a video segment, 4-part series on this very issue. We can break apart those details. A lot of it was very visually heavy because it's a podcast and it would be boring to show the charts and the graphs here on the YouTube channel, however you're consuming this content. It doesn't necessarily make sense. But the finer points are is from the high level, the 3,000-foot view, this has happened before. And when you chart, and you go back to every recession, the last 4 we've had, what the Fed has done in terms of raising rates and then how inflation responded and then where interest rates, long-term interest rates would go after that, we are almost charting exactly. And here's why this is important, because the sensationalistic news is that inflation has reached a rate that we haven't seen for the last 40 years. How is this going to play out in the housing market? Well, housing prices crater. That's what you're hearing. And it's just not true. Housing is still at a shortage. So it is going to weather its, the price, what you pay for it over this soft spot in the market because interest rates are higher. Now, a lot of people are pumping the brakes because they're like, dude, I could get the same house for $600 cheaper 6 months ago. That is what has people pausing, right? But the truth is every time we hear a recession and the government formally announces that we're in one, rates actually fall. So there's this period of time right now and that everybody is really focusing on this inflation. The Fed has actually said that they're going to continue to fight inflation until they get it down to 3%, which means they're going to continue to raise rates. We're going to have another rate hike here in October. As you're listening to this recording, that's going to be another 0.75% to a full percent. That's going to continue to push rates higher. But again, this always cycles because once we get into that recessionary period, when rates start to fall, now you're going to see everybody refinance, right? So it really is a conversation of market timing. The perspective is not necessarily right now. It's your ability to understand historical view. Right? And if you understand that historical view, you can look for the next opportunity and plan appropriately. And then if you're taking some of my other points, where you're not pushing to the top end, or you can add roommates into your housing situation to get over these temporary bumps, or you're leaving adequate reserves on the sidelines, then you take a conservative approach to maybe a more volatile situation. But you're still safe. And you still have assets that you can bank on and leverage to get you where you need to go for future wealth. This has been an episode of Build a Lender Podcast. I hope you found this information useful. If you have any questions or need more information, please reach out to me on my cell phone at 303-877-6323, or you can always email me at brodriguez@houseloan.com. Until next time, we'll talk to you soon. This has been an episode of Build a Lender Podcast. Thanks for listening to Build a Lender Podcast. Please reach out to me with any questions at 303-877-6323.